So there's two things. The market in Europe is more global, but the market as a whole is more US-centric than it's ever been. And I think that creates an opportunity because if I was to take a 5 or 10-year view, my guess would be that the US dominance of global markets has probably peaked and will begin to come down. Right now, a stock we find very attractive, particularly after the disruption in Iran, is Ryanair. Ryanair is probably the world's best airline in terms of profitability. Consistently, the company that we would think of as being the best in return on capital employed and consistency in management is Inditex.
I love it. Muy buenos días y bienvenidos a un nuevo programa de Inside Lounge con Fan Society. Mi nombre es Elena Santiso y soy cofundadora de Fan Society. Ha pasado ya más de un año desde que la gestora europea Jupiter Asset Management reclutó a su nuevo equipo de renta variable europea, una tríada de gestores estrella compuesta por Niall Gallagher, Chris Sellers y Chris Lake. Hoy tenemos el placer de contar con Niall Gallagher, que es el gestor principal del Jupiter European Select y uno de los profesionales más reconocidos dentro de la renta variable europea. Como comentaba, Niall se incorporó a Jupiter en mayo del año pasado junto con una parte de su histórico equipo de inversión procedentes todos de GAM, donde lideró las estrategias de renta variable europea desde el 2009 hasta el 24. Pasó antes por T. Rowe Price y BlackRock, de lo que supone una sólida trayectoria en el análisis y la selección de compañías europeas. Su filosofía de inversión se basa en identificar empresas capaces de generar una rentabilidad sobre el capital empleado superior al coste de capital, así como equipos directivos con una asignación eficiente de capital, un enfoque que ha definido su estilo de gestión durante más de 2 décadas. Niall, thank you very much for joining us. So you have been in Jupiter since May 25, and you are leading the same team that successfully managed European equities at GAM for so many years. You have a very highly differentiated approach, flexible and style agnostic, with a concentrated portfolio of 30 to 50 holdings and an investment philosophy focused on identifying companies that generate return on capital above their cost of capital. The team also brings more than a decade working together and a strong long-term track record of alpha generation in European equities. So with that background in mind, I'm going to start by asking, when you compare today's market to the one that you encountered when you started your career, what surprises you most about how Europe has changed?
Yeah, I think to think about how Europe has changed, we have to think really of the global context. And I would say there are two things that are very different about the European asset class now versus 1998, when I first came into the market. The first is the companies are much more global now than they were back then. So if I look at the European equity market now, about 60% of the revenues of the European stock market, so that's the revenues of the companies that make up the market, are from outside of Europe. And if you go back to 1998, that figure would probably have been about 30%. So the market has become much more global. And if you think of the big companies in Europe, ASML, Novo Nordisk, LVMH, Inditex, these are generally businesses that operate all around the world. So the first thing is the market has become more global, which means when we think about our companies and we analyze our companies, we have to pay a lot of attention to what's happening in the United States, in South America, Central America, China, other parts of Asia, because they're all relevant to what our companies do. That's probably the biggest change. But I'd say there's one other change too, which I think everybody should think about. And that is the concentration of the world stock market into the US is unprecedented. The US has never accounted for a higher share of the global market capitalization. Within the US, we also have extraordinary concentration of companies. 10 companies in the US account for about 42% of the S&P 500. Within the MSCI World Index, the US is nearly 75%. So the second thing we are dealing with is just the extraordinary concentration of the US in global markets. But then if I turn that upside down, Europe is a smaller share of global markets than it was in 1998 too. So there's two things. The market in Europe is more global, but the market as a whole is more US-centric than it's ever been. And I think that creates an opportunity because if I was to take a 5 or 10-year view, my guess would be that the US dominance of global markets has probably peaked and will begin to come down.
So now many investors continue to look to the US for growth. What is the most undervalued opportunity you see in Europe today, and how is that conviction reflected in how do you position your strategies, the strategies that you manage at Jupiter?
So I would say there's a few aspects to that. So within a global context, European equities are probably the cheapest major asset class. So if we look at the price earnings multiples relative to history, Europe is still about average, whilst most markets, the US, emerging markets, Japan, are expensive versus history. So our market overall is cheap. But if I look within the context of what we find attractive, there are a whole bunch of things. So we still believe that if I look to the more domestic part of Europe, some of the banks are still very attractively valued. In this region, in Spain, there are some excellent banks that are generating a lot of cash, that are attractively valued. The same is true in Italy, in Greece, in Ireland. So we find the banking sector in Europe is still cheap. If I look towards areas that have a bit more growth, some of the European electrical industrial companies, companies like Siemens Energy, Prysmian, Schneider, Infineon, that are geared towards electrification, and of course AI drives electrification. Those are attractively valued. And then we have a whole range of just idiosyncratic single stock ideas where we think the returns are attractive and the valuation's low. So right now, a stock we find very attractive, particularly after the disruption in Iran, is Ryanair. Ryanair is probably the world's best airline in terms of profitability. It's now certainly almost one of the biggest. It has generated consistently the best returns of any airline company globally, and the valuation is low. So that's probably an area where we find great valuation upside. And then I can go further. We can talk about steel. Now, steel might seem a strange stock or a strange area for a manager focused on high returns to go into, but there have been some important changes in legislation in Europe, the introduction of the capital border adjustment mechanism, the introduction of tariffs, and because of that, we think the return on capital employed of ArcelorMittal is likely to go up, and we find that stock very cheap too. So there's a whole bunch of things that are interesting, that are different, that we find attractive.
So your process revolves around, we mentioned that before, a very specific idea, investing in companies capable of generating returns of capital that exceed their cost. What is the best European company? And you already told me, so I'm really excited. I'm looking forward to listen to your answer. What is the best European company you've encountered from that perspective, and what made it special?
So I would say that consistently, the company that we would think of as being the best in return on capital employed and consistency and management is Inditex.
I love it.
This is a company that we first invested in 2005. And I made my first trip to Artexio in 2005.
Oh, you've been there.
Been there a few times. In fact, my colleague, Chris Sellers, is going there in 2 weeks' time, again, to visit Zara in Inditex. So it's a company that we've followed for over 20 years. We've been invested in it for that time period. It's a unique business. It generates high returns, but it's the consistency of the story. If I think of Zara, obviously Zara changes throughout the year, not just every season.
Yes.
And they manage to hit the fashion spots all the time. But the consistency behind Zara is the model. The attention to detail, the speed of being able to bring new product into the shops, the ability to change, to have feedback from the customers reflected in how they design, and then having a supply chain that is able to respond very quickly. So that's really a uniqueness about Zara, which nobody else has managed to copy. The other formats have their own individual personalities, and they grow too.
But have you seen any changes, with the change of the management? The owner retired, and now his daughter, she's in charge, and they changed all the management, the CEO. Have you seen any? What do you think about that change within the company?
Certainly from the outside, we have not. Now, maybe inside the company, it feels different, but I'd be surprised. It always struck us that there was a very strong culture around Inditex and Zara, which I guess comes from the owner, and now his daughter running the business. And the fact that there has always been a strong family feel to the business. So from the outside, we can't see any perceptible difference. Now, obviously, as I mentioned, the range of items in the shops is always changing. So it's a dynamic company in that respect. But the core culture that has generated this ability to move and change doesn't seem to have changed that much. If I was to pull on one thing, if I was pressed to say, is there one area where it's changed? I would say over time, Zara has probably moved slightly upscale. So the items are probably now a bit more highly priced relative to where they were 25 years ago or 20 years ago.
I agree.
But I wouldn't say that it's a massive change. It's still maybe not quite affordable luxury, but affordable chic. The consistency that we see, though, is not just in the way the company generates fashion. It's also in the conservatism of the balance sheet and the financing. This is a company that's always had a very strong balance sheet with a lot of cash. It generates cash. It's run very tightly, which allows the business to grow and reinvest. And those things have been constants. And when you pull that together, what we have is a business that generates high returns on capital employed. It grows. It has a long runway for growth still. It reinvests. And we've always been surprised at how forward-thinking and forward-looking the company is. They seem to get to the best position a few years before everybody else has even thought about it, whether it's technology or China, and then maybe slightly de-emphasizing growing in China and focusing more on growing in the US. Inditex, and especially Zara, seems to have been usually 2 or 3 years ahead of the rest of the competition. So that's what we like about the business. The conservatism of the balance sheet, the high returns on capital, the cash, but the very dynamic, forward-looking nature of the concepts, particularly Zara.
What does this new chapter enable you to achieve for investors that you haven't been able to do it before?
So I think very much for us, it's about just taking the opportunity from working at a great institution like Jupiter, an institution with a strong historic track record of high alpha generating investment strategies, and then looking to carry on doing what we were doing in European equities before. So very much the strategy, the process that I use is one that was developed in 2003, so 23 years ago now. The team have been together, as you say, for a very long time. And our goal at Jupiter is to carry on generating as much return as we can for our clients in a new institution for us, which has got a very strong heritage in high alpha generating strategies.
So when a team with such as you were mentioning, with such a solid track record changes firms, I guess that culture, it's a big deal for you. So what did you find at Jupiter that made you feel it was the right environment for your management style?
So we knew Jupiter quite well before we came. So we know some of the key people in Jupiter. So we know the management well. Obviously, I've been working in fund management in London now for 29 years. So I knew Jupiter people and have known Jupiter people for a long time. And then, of course, I mustn't forget that some of our colleagues from GAM, Adrian Gosden and Chris Morrison, who manage our UK income fund, turned up at Jupiter about a year and a half before us. So we knew the institution well before we joined, which is important. And in terms of what attracted us to Jupiter, it's the focus on individual teams having accountability for their performance, for their process, an institution that's grounded in the belief that managers should be looking to generate high alpha and running high conviction portfolios, but also we like the collaborative nature. So we spend time talking to other teams who do different things, who have different ideas, who give us different perspectives. So that idea where we can generate alpha using our process, but at the same time work in a collaborative environment where there are other smart fund managers with interesting ideas.
So you have been managing European equities for over 20 years. What has been your best investment ever? Your best idea?
There's a few, but I'll pick on one. So in 2008, when I was at T. Rowe Price before I went to GAM, we bought shares in a house builder in the UK called Persimmon.
Okay.
This was at the trough of the global financial crisis. So markets had fallen heavily. People were very, very concerned about the housing market in the UK. Mm-hmm. The stock was trading on less than book value. I think it was trading on half book value. But it was a company where I knew the management well. I knew the CFO in particular was very conservative with his balance sheet and that they had put cash aside and they had been very careful. So whilst every other house builder in the UK had to do emergency capital raising, this company did not. And then through the period 2008 to 2021, we held this company and they generated extraordinary returns. I think the shares in value terms went up by over 20 times in the period I owned them. And then when I sold the shares, the dividend per share every year was higher than the price I paid for the shares.
Wow.
13 years before. So it was an investment that made us thousands of percents. What was it about the business? So first of all, it was a management team that were excellent at capital allocation. So not only do they run a very good balance sheet structure, but they were phenomenal at buying land, and they were also contrarian. So they were buying land at points in time when people were very depressed. They had a very good land strategy of taking agricultural land in the UK, bringing it through development, and then bringing it through to build, which was very profitable. They used the opportunities that government gave them in terms of incentives very well, and they kept a very tight lid on costs. So through all of those things, this business, which we bought during the depths of the global financial crisis, ended up generating returns on capital employed of nearly 35%, generating extraordinary amounts of cash, returning that cash to shareholders, and it was a very profitable investment. So that was probably my single most profitable investment in my career.
Last question. If you were a portfolio manager, what would you be?
Goodness gracious. If I had a different physiology, I'd like to be a professional cyclist.
Oh,
but,
really?
But that's more of a dream. I don't think that would ever have happened. But yeah, probably a professional cyclist.
Well, thank you very much. It has been a pleasure having you here. I wish you the best in this environment, this really tough environment. So thank you very much for being here. Muchísimas gracias y nos vemos en el próximo capítulo de Inside Lounge de Fan Society. Si no quieres perderte nada de estos contenidos, suscríbete a nuestro canal de YouTube.